Ready.
Welcome to Momentum Monday. Today is Sunday, April 19, 2020. Happy Easter to all the Orthodox Christians. Howard, what's going on in Arizona?
I think we can eat bread again. Passover's over.
That's good. What type of bread?
Any bread. Pizza, bread, muffins, bread. You're looking fit. What are you working on?
Everything. Every day a different muscle group.
Yeah, I'm just working on my voice. I've been out biking every day.
There are actually some exercises for voice.
Yeah, I was just kidding.
Okay.
Let's call this episode the biggest wall of worry of all time. I think we're starting to see where at a time when the media's never been louder since 2008 maybe, but this whole 4 years of Trump have been loud. I don't think it's ever been louder than COVID. So you take off, Ivan, and talk about this, what's happening out there.
Well, there is a big disconnect between what's currently going on Wall Street and what's going on Main Street.
Correct.
They say that the market is forward-looking, and it seems at this point the market is basically saying that 6 to 12 months from now, things might get back to normal. So, I mean, the market constantly strives to discount future events. So sometimes it ends up being right, sometimes it's very wrong. But at this point, it's just discounting, getting back to normal. And now we are entering a phase where the market will just look for feedback to see if its initial thesis about the recovery is going to be confirmed by the actual numbers. So now it will be really interesting to see how the market will react to earnings reports, to economic reports, to healthcare reports for the next 6 months. Because if in the next six months we don't start to see a substantial improvement in those numbers, maybe the market will decide that it's been a little bit too optimistic. We might see a different leg lower. But as of right now, stocks are extremely strong, at least in tech, especially in biotech. Last week, the biotech ETF IBB closed at new 5-year high. So I'm pulling up a monthly chart. You can see that super long 5-6 year base, and the entire index, that's the large cap biotech index, closed at new 5-6 year highs, which is a substantial event. I mean, granted, it could be a fake breakout, but as of right now, looking at all the setups in biotech, and we mentioned quite a few of them last week, there is money pouring into that sector, and it's
pouring. Ivan, I mean, as a non-biotech person, I think you said some of the smartest things this week. First of all, yes, you're going to have this wall of worry, and biotech doesn't necessarily fit into a wall of worry. It fits into a world of risk on, right? You have to be really balls to the wall, because the mass market has just become an expert in epidemiology. And I say that as a joke, right? Like, no, they aren't. There's some smart people in math and doing the numbers, but the money's flowing in at the worst possible moment, the news cycle that we've ever had, the misdirection. And if we look at that monthly IBB, because we don't need to look at the indexes quickly, because the indexes are masking so much of what's going on. The highs that it's taking out, going back to 2015, 2000, those came after a very long run. So really, we are, for all intents and purposes, based on the type of market we're in, a news cycle, this is like a massive relative breakout to everything. And it's not just, hey, Gilead or Abbott Labs that might have a cure. This is like Amgen going back to all-time highs here, basically. And these were vicious sell-offs. Well, maybe it wasn't a vicious sell-off. If you look at the weekly, it was a nasty sell-off, shook a lot of people out, because of the false breakout. And now here we are right back, and they're not even involved in COVID. So you had been talking about a lot of small biotechs the last month that were showing strength. And I think this is just a bet on science. Like, we may never get good at manufacturing again in the United States, although I'm sure we will. We may not get good at uh, running airlines or industrial companies, and we may screw up a lot of things. But I think we all can appreciate science a little more, and looks like a bull market is heating up.
I mean, yeah, I mean, for the past 2, 3 weeks, we're definitely seeing an increasing number of accumulation day, which basically means that institutions are putting money to work. You can see how even the slightest dip in the Nasdaq 100, just mostly large cap tech, is getting bought, which
Yeah. Yep. And this wall of worry that I talk about, it's like you're forever going to see old economy stocks have to have COVID financials, right? Like, what if COVID happens? So that's a wall of worry that's going to continue forever, and rightly so, right? For certain industries, for older world industries where people have to come into offices, and it's not a work from home industry like banks and airlines and travel and hospitality. You know, you could go, and I just don't know why you would spend your time thinking about it, because those really are permanently affected, you know. Whereas the cloud-based economy and the Nasdaq one, cloud-based in healthcare, like we've been talking about, the Nasdaq 100, that's the cloud industry. I don't think it's representative of all the great companies in the industry. But if we just go,
yeah.
if we just go simply the Nasdaq 100, which seems to be bouncing the most interesting because it's a diversified of the large cap tech, of software, of healthcare, even a little bit of industrials and biotech. That's what I've been telling people during the panic to focus on. You know, the same yield as the treasury bills at 1%, obviously with more volatility, but in a world where bonds are going to pay you zero, and you've just learned that there's massive volatility around COVID and disruptions. Why would I take that volatility that you see in the bonds when I can take the same volatility in the Nasdaq 100 and know that the top 4 companies are basically like the Treasury? So what makes up the Nasdaq 100? Microsoft, Apple, Google, Facebook, and Amazon. They have more cash. They're more trusted. I trust them more than the Treasury at this point. Plus, they're the ones that are going to solve the healthcare crisis, or at least the distribution of sets. So I think what we're seeing, and again, this could roll over, but I think the evidence that I see in the price action is that money is flowing into digital first assets. First of all, because companies that aren't digital first have to now have no last chance. This is 100% get digital, figure out how to work from home. This is going to be built into every business. So companies like Cloudflare or Akamai, if you look at Net, which is like a young Cloudflare, this company's going to be growing 4 times faster than any analyst expected because of COVID, because everybody's just get me a VPN, get my team and communications locked down. And look at Akamai with the oldest version of VPNs. Okay, go back and look at a weekly. This company has completely scared out, momentum people, because new highs breaks down. Are you at the monthly? Go to the monthly. They've been around since the first internet. Okay, this company is now, for all intents and purposes, at all-time highs. And so this company, you may not, or you may like or dislike their products as a technologist. They have a patent portfolio that's bulletproof around security. They'll fight anybody, and it may not be a huge growth stock, but money is finding digital survivors and piling into it. So there's another winner in that space. If you look at DocuSign, for every reason you didn't want to use it before, and don't get me wrong, this is like nobody thought this could be a $20 billion company, including the venture capitalists that backed it. So I don't know if no one thought it could be a $20 billion company, why can't it be a $40 billion company is all I'm saying. And if I own apartment buildings in 2020, and I'm a billionaire, do I want to put my money in one more apartment building, or am I going to put $1 billion or $2 billion into these digital assets and take the volatility, knowing I don't have the headache of dealing with, an America that really is doing a poor job around COVID? So I think this is the kind of stuff you're seeing with money flows, Ivan, and this is that wall of worry that, we're scared to buy stocks because maybe we're not supposed to, and the headlines are terrible. But if you look underneath the surface and beyond the S&P, you can see real pockets of strength in real large companies. And I think you got to look at the price action more than you look at the headlines.
Yeah, definitely. There's been a substantial improvement in the underlying price action. And as you said, the market will continue to climb a wall of worry for quite some time because the bears definitely have strong arguments, the bull have strong technical arguments. So there's something for everyone. If you want to be bearish, definitely you have the arguments for that. And if you want to be bullish, certainly. I mean, but we're here to make money, so we focus on setups.
I was shocked by Lulu. You said something funny, but like Lulu's, I sold some, because I remember buying it 2 weeks ago or 3 weeks ago at a 130, 140, and happily selling at 170, 180. And and you said something funny. It says as if the market's assuming the $1,200 that young people got is already spent at lulu.com. Maybe it is. You said it like in a funny way, but the only clothing you need is Lulu. If you're going to work from home or the office, no one's going to care about your suit or tie anymore. I think there's some people that saying dress for the job, but you know what? In an era of what we just went through mentally, and obviously the lasting effects of it, Lulu is showing that once people start, it's already assuming, and it's surprised even me, that people are just going to spend people aren't going to hold on to these checks and hoard money. They're going to spend it on certain brands. Look at Nike. I never would have thought, and I sold some of my core Nike here last week. I never, when I was saying to people to buy brands, a month ago, Ivan, on the show, like to treat these brands like venture capital, I did not in my perfect world see Nike at 89. Didn't. Saw it maybe in the mid 70s, and it was a great trade. And so, now is the time for me personally to take some money out of these brands that bounce farther than I thought: Disney, Lulu, Nike, and McDonald's even, which rallied, and Starbucks, and take it out of these brands and look for even more digital exposure. So I think you can see a world where McDonald's and Starbucks and Nike correct more now than the rest of the digital assets. So it's really going to be an interesting next 2-3 months as we see, people move money around. The markets, the money moves really fast. And so we've got that bounce, the S&P and the banks, and we've got, restaurants, and we've got certain retailers. But I think you could waste your time farting around an old economy. But I think now the hot money and the smart money is looking for an all COVID-free digital portfolio. And I think that kind of just makes sense. I'll take the volatility of earnings and outside effects for a company that can grow sales and do work from home at the flick of a switch and survive in a work from home and stay at home world.
Yeah, I mean, there are definitely quite a few stocks that are up to potential resistance. So there's some decent short sellers, but also there's stocks that are setting up on the long side. And for example, in enterprise software, which is supposedly they should be in trouble in an environment where companies are slashing costs, but their stocks are acting very constructively. Look at
Yeah,
AYX.
AYX is a favorite. I don't know the product that well. Team hit all-time highs, Ivan.
Yes, Team is definitely
Jira, which is just what every company needs to deploy for planning. Not all-time highs yet, but that's pretty good results. Zendesk, which I would think would be one of the weaker segments because they're going to lose a lot of retailers. You can see, so not every enterprise is the same. It's bounced nicely, but they're going to, while they gain customers, they're also going to lose customers in customer support software. So it's not all winners in enterprise. Because they're going to both gain and lose customers, they have a lot of old economy customers. So you've got to be really careful in enterprise now. But you can see that like Team is working. I'm trying to think of a few other enterprise ones that are working.
Now there's another one that is kind of, I mean, it's back to its declining 50 days. So
but again, like so many people cutting their marketing HubSpot too. Like it's not the same stock it was because they've got to chew through a lot of old world customers. So enterprise has now become kind of a mixed bag.
Exactly.
So I'm avoiding it in general. And Trade Desk, which is a great company, is very reliant on advertising. It's like CME for ads. So you need a stronger economy. And we'll see it even in the FANGs, Ivan. Look at Google and Facebook, which are more reliant on ads. So I think you're going to even see more of this. It's like, listen, you can love Facebook, but you got to realize it's an ad-based business. Same with Google. They're not performing as well as the truly digital companies like Netflix, Microsoft, and Amazon. And so it's narrower, and I'm not that makes me a little bit more risk averse, which is why I'm not 100% long. But I just don't want to be short a market where there's so many digital winners coming along. I'd rather focus on the ones that are working. You obviously look at it differently, but Mongo's another good example. Open source software. These companies were built for work at home and remote work. Elastic is one that I bought last week, even though it hasn't been a winner. It's working early. I think in a world of remote work and in a world of work from home, if we go back to Elastic, I think as Amazon and as Mongo focus on their core, Elastic, which is, kind of been beaten up because of the worries about Amazon and Mongo coming after them, I think they may sneak back up the right side here. So we'll see. And then in the biotech, Ivan, we'll come back to TechTan. What smaller ones in the biotech are you still following?
I mean, there's so many of them. Obviously with the IBB at 5-year highs, you have so many setups in biotech, and they're just starting to break out or just setting up for potential breakout. And
wow.
Just open the XBI holdings, the XBI ETF holdings, and you probably find 10 okay setups.
Yeah, you can do that in Koifin as well. You can look at the individual stocks. Okay, so you've got biotech, semiconductors, Ivan, too, doing well, I think.
Yeah, absolutely. Some of them definitely.
Yeah, they're just eating through this resistance. Yeah, NVIDIA looks strong too. AMD, NVIDIA, those are my two favorite. I don't know, they're good. I mean, it just
definitely quite a few of them are just have been on a
tear.
Buying spree, yeah.
Oh my God, Imphi, what do they do? Servers, routers. I don't know. I think people are really going to miss out. I think you could see a market that's flat in the S&P, and you could see 50%, 800% winners in certain tech stocks.
Yeah, it's a market of stocks for sure. Yeah,
we are definitely in a market of stocks. What else? So we've got in biotech, digital stocks.
I mean, the comeback in Shopify is just incredible. And a month ago, I tweeted a really old interview of the founder of Shopify, and at the time he mentioned that back in 2008, when the company was still a small startup, a private company, he was very close to signing up a funding deal, but because of the crisis in 2008, everything failed. So he was wondering if his business will survive. But 2008 actually ended up being an incredible tailwind for his business because many unemployed people, laid off people, just started signing up for his platform. So they saw an incredible growth, and it seems they're seeing the same thing right now because just last week they reported a huge uptick in new signups as more and more companies.
Well, if you want to do business, say you're a media company, Ivan, like StockTwits, and you want to juice your revenue, you can set up a Shopify page and ask your customers to buy StockTwits gear, right? It's a no-brainer. And so Shopify is a stock that was my stock of the year at the beginning of the year when I wrote about it. I didn't expect it to survive this well. And if you go back to the weekly, Ivan, or the daily, back to the daily here on Shopify, for people that want to see double bottoms or a retest, you can see that the great stocks did retest already. Like from their violent sell-offs, there was a big rally from 300 to 470, and there was a nasty, things are moving in much narrower time. And so while there may be retests in the S&P because of Boeing and because of the airlines and because of banks and because of retailers, you're not going to see the tech stocks probably, unless we roll into a complete depression bear market, which is you got to use money management. But at the same time, you've got to get yourself out of this bearish mentality in this new era because of the cloud. You really are talking about land versus cloud. If you're a land-based business, things suck. Neiman Marcus, I think, filed for bankruptcy today. There's nothing they can do as a company that's land-based fast enough to survive. It's just a tsunami of bad, the trend was terrible anyways, but so you're still going to have a lot of negative headline news, but I think we have now reached a point where so much money is being printed, interest rates are so low, and there's so many digital assets companies that are growing through this that you have to ignore the terrible headlines that are coming and focus on the price action. It doesn't mean you have to be 100% long or that you can't make money shorting stocks. I'm just saying a lot of smart money is seeing through this for a repositioning of their portfolios towards digital. And you're going to hear a lot of terrible news over the next 6 months to a year. So get used to it. I just think that adds to the wall of worry that you brought up this week. And I think we're going to have the biggest wall of worry of 20 years ahead of us. It may not be great for indexes, but it's going to be really good for companies that you've never heard of. They're growing faster than ever. Not their fault. It's just I'm talking to them and they're growing faster than ever because they were built from the ground up as like these Mongos or Elastics. They were built from the ground up as global remote companies. And so you're going to see even more of those companies get started right now. I'm trying to think of some other stocks that continue to do well, Ivan.
Well, Roku, I brought up Roku recently. They just
do you use Roku, or are you an Apple? Do you use? I just don't use it, so I'm not
using it, but I'm definitely trading the stock. And this is just an incredible comeback. They just raised guidance here, gapped up. They're already back above their 200-day moving average. Look at the.
Yeah, and you can see all these had a little bit of double bottoms. Where they not so much Roku here.
Well, the cleanest double bottom is obviously Netflix, especially if you pull a monthly chart. Look at it.
Yeah. So, again, it was digesting humongous gains.
Exactly. That's
it took a year or two off, which is just so bullish. It didn't go down. It took a year or two off going sideways and making sure you were loyal to the company. And
the technicians take that move the depth of that base, which is like around 150 points, and they add it to the breakout point. So
so we easily see 550 here.
Yes.
And again, I think you need an okay market for that to do that. And I think with the money being printed and the fact that the government backstopped the bad companies, we could argue all day long politically or economically if that's good or bad, but the market's saying, get me some risk on. And I think, and it's so bearish out there, Ivan. It's just so bearish. It's even on StockTwits, which is a generally bullish community, very bearish. So I hate to trade against sentiment only, but it's another signal that a lot of smart people, and it's, smart people always sound smart when they're the economy, when they're talking about what could go wrong. And I think that story is now 2 months old. And if you're from China, it's 4 months old, and it's real. But at the same time, there's companies behind the surfaces just exploding in growth.
Yeah, the bearish arguments are clear to
Clear.
everyone knows them. I mean, there's nothing new, there's nothing secret. So sometimes the market can be just a little bit anti-intuitive for many people, and it actually often is.
Yeah.
It just goes in the opposite direction of what the mainstream expectations are.
Yeah, and you're going to see the big get bigger. Scott Galloway did a good post about if you look at the four horsemen. So if we look at Netflix and Amazon versus Microsoft and Amazon, sorry, you can see the other effect of, you can see the other effect of bad. Well, I mean, it's hard to explain this. It's such a big company, Microsoft, but it looks more unstoppable than ever. And mainly because who is going to stop them, right? Like the pie is big enough for the four leaders to just say, listen, government's not working. Let's have a truce. We're all going to compete with each other, but let's come up together with some products that work. Now, maybe not Amazon because they can beat everybody, but between Microsoft, Apple, and even Apple and Google are already working on, apps together for tracing, et cetera. So the market is big enough for these four companies to be in further cahoots together and act like the government, but either by themselves or together, because the government's too busy, fighting and with each other, and just like the government sneaking in things while we worry about COVID, these four companies are going to be as ruthless as ever around antitrust and around getting away with things. So we don't know if it's good or bad. It just is. So I think, how are you positioning yourself, Ivan? Are you high cash still, or are you?
Yeah, high cash, but I'm very active.
You're very active. Okay.
Yeah, every day there's some amazing opportunities. It's a great trading opportunity, trading environment. So I'm trading with both the long and the short side. I'm using options where it's possible, especially in those large caps like Apple and Netflix and Roku. They have
even more nimble. I'm still high cash, but no shorts. I had a small S&P short that I'm just going to unwind again and just stay 50% long and look for some other opportunities. But the amount of stocks that look interesting to me based on that QQQ chart, and Microsoft and Amazon and Netflix, will pull back the QQQs. I see pullbacks, right? But I also don't understand why people wouldn't, in a rate world of never really broke its monthly. I mean, like the only thing that seems to me that can truly create a bear market in tech is the cloud going down. And I mean, that was as nasty a 1 month panic as you're ever going to see. So let's go back to the weekly here. You can see the December when the United States government closed down, right? December 18. So that was when, the Apple scare, China scare, and this is, you got to understand, this scare in 2018 was probably Apple's last chance to get their shit together with China, right? That was a warning, so they've already had a year and a half to kind of think about production and everything outside of China, because that was the scare of, we hate China and the China drone. Okay, so going back to the weekly of the QQQ, Ivan, my hypothesis is, look how bad the Nasdaq 100 sold off when Trump threatened to shut down America. The world was shut down a year and a half later, and the Nasdaq 100 stayed above the USA closing. So the whole world was shut down today, and we didn't take out the lows of just the US being shut down. So if that isn't that could be the greatest fake of all time, that we're going to roll over today and we're going to take out the 2018 lows. And, hopefully I'm smart enough to reverse course by then. There's enough knowledge. But right now, I think the dips in the Nasdaq 100 will be bought aggressively, because you also have, like I said, the backstop of the government printing. You have this massive move from non-cloud companies to the cloud. This was it. They have to 100% all in. Thirdly, Ivan, you have costs coming down, and it's never been a better time to recruit for these large tech companies, right? They're going to continue to take the best employees from old media, retail, et cetera. So you're going to have, this is that story that the old world could keep getting worse, the old economy, and the new economy could keep getting stronger. So as tech companies laid off people into COVID, they're going to hire stronger and stronger people from other industries to further, accelerate their businesses. But it will take something that I can't see that exists on page 10 to slow down the NASDAQ 100 at this point. So hopefully that helps people just at least get out of the frame of mind that the world's coming to an end, because I think you'll get plenty more warnings. I think until we take out the lows of a couple of weeks ago or 3 weeks ago, you can comfortably start, if you're underinvested, buying some dips. But I would keep it to biotechs, the top semiconductors, 100% digital focused, remote companies. They're not going to be cheap. I mean, for sure they're not going to be cheap. But in a world where bonds are 0% interest rate, the government's backstopping, and the fact that old assets that were guaranteed some home run layups for rich people, commercial real estate and regular real estate, I think a lot of that money finds itself moving into the NASDAQ 100 as well. And this is the bond chart, Ivan. What are you seeing?
It's looking strong. It's consolidating near its high. So as I said, there are some bearish arguments, there's some bullish arguments right here, and it just depends. What do you want to be right here?
And this is implying that rates look to be headed lower.
Yeah.
And I don't know. I'm just going to stay away from the rate argument.
And of course,
they're just low. And in a low interest rate environment, that's gold.
Yeah, that's gold. Big breakout last week, but it finished near the lows. So it might have been
not exciting. I think you can buy the dips when they're printing money like this. But again, I think digital assets make more sense. But it does look like gold for the next few years is going to be going stronger.
Yeah, it's looking on a big base here, yeah.
All right. Well, I think we've covered it. At least we've kind of explained to people. And I think, Ivan, let's check in on some of my venture capital as stock ideas. A couple of weeks ago, I said, listen, you can go and buy some of these broken large. I was talking about the fintech companies in Latin America that were, Stone was one, and you can see over the last 2 weeks it's up 30%. And so I think IQ was another one, or XP was another one. I think that's up 50%.
Okay. Yeah.
That's like the E-Trade. So it went from 18 to 25. So again, don't chase these ideas, but if you really want to, Melly had a great run. So I'm saying some of these are just rallying into resistance, and they're going to take a lot of time because money continues to just flow into the leaders. But I think there were some significant bottoms made in a lot. PAGS is another one. I think there's some significant bottoms made in some of these in these fintech and digital companies that are in Latin America, et cetera. So we'll see. Keep an eye on those, but those are more venture capital.
Yeah, keep in mind that emerging market stocks are definitely a lot riskier right now than US stocks.
Yeah. Well, the way I brought it up 2 weeks ago is like they're broken, they're below their IPO prices, and they're leading products, right? So there's nobody that wants them, so you have to treat them like venture capital if you believe in the future of fintech in these other areas. But if you look at the Nasdaq 100, it's where the money really is flowing, and so I don't think there's more important chart than that right now, and it feels like a 10% correction feels like it's needed, but I'm looking at that chart, Ivan, and I'm like, it may not look back.
Yeah, I mean, it can go sideways here. It can stay between 200 and 220 for a while, and that will be constructive because basis will be formed.
Yeah. Okay. All right. Have a good rest of the day. I'm going to put this up and we'll share it.
All right, you too, Howard.